Why don't we ever talk about valuation when we're talking about stocks? We get this question all the time. We wanted to tell you a little bit more about how we think about valuation and why we don't really talk about it on the channel that much. My name is Brian Feroldi.
And my name is Brian Stoffel.
Brian, when I say valuation, what comes to mind for you?
To me, my life as a beginning investor and a whole lot of worrying about stuff that over time has mattered less and less and less to the point where it just doesn't matter at all to me.
That's fair. I will tell you that when I started investing, I read all the classic books that you read about investing. I studied Warren Buffett, Charlie Munger, Ben Graham. What do they hammer home time and time again? Valuation, valuation, valuation. It seemed to me like the only thing that mattered in investing was buying $1 for 50 cents, and then you wanted to sell that 50 cents when it got to 90 cents or whatever. And because of that, that was the lens that I looked at the investing world through. It was valuation first. Business quality didn't matter. Valuation was what drove decisions. And there's lots of investors that invest that way today. I think it would be fair to say, though, that over time, I have learned to significantly de-emphasize valuation. And some of our viewers might be shocked to learn you don't even look at valuation.
I don't. I'll look at valuation if a company isn't anti-fragile, and we'll talk about what that means. But I don't even bother with investing in them. For me, it's just an interesting thought experiment.
All right, fair enough. So we have a little presentation for you. So Brian, talk to us about the Antifragile Framework and how you think about valuation.
Right. So I decided that I would just prioritize anti-fragility instead of valuation. But we got to back up a little bit and talk about why. So the environment that we live in has changed drastically. This is all from Nassim Taleb's book, Antifragile. For most of our evolution, we've lived in what he calls Mediocristan. And what is that? It's a place where the average distribution, your normal distribution that we see and took when we were in math class in high school and in college, it kind of was the way the world worked. There weren't too many extreme situations or circumstances that have, so everything pretty much fell on this curve right here. But because of technology, we now live in a world that's more extremistan. And here's what the graph looks like for that, where still most things happen within a very relatively confined range, but there is this long tail now of results. There's just a couple of them, but they account for a huge amount of the effects of what ends up happening. Let's give some real life examples. So Mediocristan, things that fall in that normal curve is like your height. If we took everybody's height in the town that Brian or I live in, they would fall on a normal distribution. Or if we did a coin toss contest and the number of heads and tails that came up, that would fall in a normal distribution. Or just one more, the birth weight of individuals will fall on a normal distribution. Most things that we observed in the world used to fall in that. But these days, because of technology and extremistan, it's different. For example, your income. If Bill Gates lived in your neighborhood, Brian, that would skew the income and make it look much more like that second graph we had. There's a whole lot that are in a tight range and then a couple people that are outliers that affect everything. Or stock market returns. It's pretty well known that one or two of your investments are going to drive most of your investment results. Sometimes people look at that and they say, oh, you're really lucky you found this stock or that stock. But really, that's the case for pretty much any investment portfolio you have or box office hits. How many movies do studios make? I mean, they're counting on one or two of them to be big hits, and that supplements all the other movies that they spent money on. The thing is, you don't know which movies are going to be the big hits beforehand all the time. So
an interesting point about that, Brian, is that Ben Graham, the father of value investing, right? The guy that Warren Buffett studied under, if you looked at his long-term returns, they were almost complete. All of his outperformance was driven by one investment, an outsized position that they took in a little insurance company called Geico. They broke so many of their own investing rules when they invested in Geico. They put a huge chunk of their portfolio into it, and they said, this business is so fantastic, we have to own it. And it was a mega mega winner that drove the entire, almost all of the outperformance of his portfolio. So that just shows me that that stock market return you're thinking about, that's not necessarily new that we're in extremist stand. It's been there for a while. And even Ben Graham took advantage of that.
And just to talk for 1 second about the fractal nature of it, if we took Geico out, the whatever the second best one is would have been that much better than the rest of it too. Like that's just how it works. So here's why it matters. Say that we've got all these inputs, okay? 99% of the time when we try and predict the future, we'll be pretty much right, okay? But 1% of the time, we're going to be wrong. And that's where a black swan, and sometimes they're not even black swans, they are somewhat predictable, but that's where these unpredictable things that happen when we're not ready for them, they arise. And you'd say, well, I'm right 99% of the time, I'm only wrong 1% of the time. What's the big deal? Here's why it matters. If all those other little black dots are the weeks leading up to September 11th, that's how much effect they have on our current world today. So much time. If you take the 5 hours on September 11th where crazy things were happening, that's how much effect it has on our world today. So even if you're right 99% of the time, if you're wrong about that 1% and that 1% is ridiculously important, it's not enough to be right 99% of the time. So let's put all this together and talk about why this matters for valuation. So step one, we evolved in Mediocristan, very predictable. Step two, thanks to technology, we now live in Extremistan. And technology started with even agriculture 10,000 years ago, and it's just gone since then. Step three, today, the principles of Mediocristan still work 99% of the time. That's how we're evolved to make decisions. And it still works most of the time, which is great. But 1% of the time we'll still be wrong. And here's why it matters. Because being wrong that 1% of the time will affect everything else. We cannot highlight that enough. Valuation, in my opinion, this is an opinion. This is not something that's provable. But my opinion is that most people, when they're evaluating a company, when they're valuing a company, they have that normal distribution in their brain because that is what we evolved to use. And that makes sense. You cannot create a valuation model that takes Extremistan into consideration because you don't know which one of those 1% of things is going to happen. So it's not silly to just focus on valuation with Mediocristan. It's impossible to do anything else. That's why I tried to come up with a different way of looking at it. But when we look at the real world, we can see how this applies. So for instance, a pandemic hits, and guess what? School districts, businesses, they don't care what Zoom's PE ratio is in March 2020. They need a tool that works. Zoom was anti-fragile in the real world, regardless of what its stock was doing, regardless of what investors were doing. If there was no stock market, Zoom was an anti-fragile business, at least in terms of this pandemic, although I would argue in general. Another example, we think about Chipotle, okay? Diners didn't care about Chipotle's PE ratio during the E. coli scare. They avoided it en masse. Mm-hmm. So that was a 1%, that foodborne illness breakout was one of those 1% things that no one really could have predicted. And it made the stock plunge because in the real world, diners were avoiding it.
Yeah, it was all over the news. I totally remember that. It was a scary time to be a Chipotle investor.
It was. Or think about when that volcano that I can't pronounce in Iceland spewed ash into the air and planes couldn't travel over the European skies. And when they couldn't, people weren't using Booking to get their hotels in places because they couldn't get there. They didn't care about Booking's PE ratio. And so these are three examples of what we might call black swans. They're not totally black swans because we know volcanoes will erupt, but these are things that are very unpredictable. They only happen once or twice, but they affect everything else. And so that's, to me, why it matters so much to look, instead of at valuation, at anti-fragility. So just to kind of review, you can either be in the world fragile, where chaos and time will basically kill you. You can be resilient, which means that you won't really change that much from stress, chaos, the unpredictability of the future. Or you can be anti-fragile, which means you can actually get stronger as chaos hits. Now, how do you measure for that? We've talked about it many times, but I've got 3 broad areas I looked at. The first and the most important by a mile is the barbell technique, which means that you have a mission that is simple, inspirational, optionable. You have a moat. We talk about network effects, switching costs. The moat is the best way of just saying, this is your defense. And then you have optionality, which means there are lots of ways that you can fulfill your mission. That's like the offense. And that's where positive black swans come into play. Amazon, 1998. I tell you, they're a computing giant that like half the internet is running through their servers. What? They sell books. What are you talking about? That's a positive black swan. That's optionality. And then the second thing I look at, which is still important, is financial fortitude. If you have lots of cash, little to no debt, positive free cash flow, and you're not counting on just a couple customers concentrated to provide your sales, then when chaos does hit, you can take advantage of it. Berkshire Hathaway, think about 2008, incredibly anti-fragile in this respect. Companies came to them asking them to fund their businesses, and they were willing to give them extremely favorable terms. If you have these things, you get stronger when chaos hits. And then the last thing I like to look at is just skin in the game. When a company's founder-led, when the insiders own a bunch of the stock and will get punished when the stock falls, the same as I do as a shareholder. And when employees are happy, and we use Glassdoor as a proxy for that, then I believe that they are more focused on building long-term value, but also are less likely to be knocked off by chaos coming their way. So that's why I don't focus on valuation. And if it matters to you, just looking at it, this is how we like to visualize it. So I add these scores up, and if it's below a 7, it's fragile. If it's between a 7 and a 12, it's robust. If it's 12 or more, I ask myself, why don't I own this company? And almost every company I do own is 12 or above. There's a couple that are less too, because I find things out that still interest me. And if you're wondering, does this work? Now, admittedly, through one of the greatest bull markets ever, the tides could turn and all of a sudden this might not work. But in general, this is not time weighted, but it's size weighted. By every investment that I've been able to record, I'm between 4 and 5xing the market. It can swing pretty wildly, but it generally has stayed between 4 and 5xing the market over the past 6 months. Or if you look at my caps profile on the Motley Fool, so you see my accuracy is about 62% of the time I'm right, which I think is a pretty good batting average. There's some who are better, but most people not so much. It puts me in the top 2% of all the investors of roughly 60,000 who've entered picks into this system. Or if you just look at the performance of my portfolio. Now, when the Motley Fool's scorecard left the universe, I lost my ability to track all of this quite so well. But over the last 3 years, almost a tripling in portfolio value, which is outperforming the market by a wide margin. And you've got my 1 year and year-to-date results up there as well. So that's why I don't focus on valuation anymore. But that doesn't mean that it has to be the right way for everyone, including you, Brian, because while valuation might not matter as much, it still matters to you.
Yeah, but you are one of the many reasons why I have learned to de-emphasize valuation as part of my process. It's really, to me, it's hard to argue with the anti-fragile mindset and the anti-fragile thinking. If you look back at, just say, take the last 20 years in the market, what were the 3 events that mattered, right? COVID, the 2008 financial crisis, and September 11th.
Yep.
Right? Those 3 events dominated everything. Like absolutely everything. The markets sank like a stone in each of those events. And in all 3 cases, valuations suddenly didn't matter. The only thing that mattered was humans were panicking and prices were dropping. Conversely, if you look at some of the examples that you pulled up, like Zoom, for example, Zoom didn't create the pandemic, obviously, but it was very well positioned because it was so anti-fragile to benefit from it. So it set itself up well to work in a COVID world, even though there's no way they could have predicted that was about to happen. So that's one thing I like about yours. It's just, are these companies anti-fragile? If yes, I want to own them. If no, I don't. But to your point, yes, I always look at valuation. I am more valuation focused than you are, but I'm not hyper focused on valuation. I just love this slide. This is shamelessly stolen from David Gardner. But he says, some investors use method one. They have these really complicated discounted cash flow analysis, and they put things in and they optimize for each line item. I'm a much bigger fan of method two, which is, do I like this business? Do I think this business can be bigger? What's it going to be worth in the future? More than it is today, right? How much more? I don't know, because that involves me predicting growth rates. If you look back at Amazon, again, this is an outlier of outliers, but it's still such a great teaching tool. If you look back 20 years ago and say, what's Amazon's revenue growth rate going to be in 2020? Was there anybody on earth that would have predicted 40%? It's going to be one of the biggest companies in the world, and then it's going to grow 40%. How could you possibly have predicted that? But if you had the foresight to say, e-commerce is growing, Amazon's a leader, I'm buying Amazon, you would have done very well. And no discounted cash flow statement could ever have accounted for that. So that's one of the reasons that I de-emphasize valuation. Another is this wonderful table that was compiled by our friend Morgan Housel. And I'll throw a link to the article where he wrote this on Fool.com in the show notes. But he did a study where he looked at the actual PE ratio of the 30 Dow components in 2012. What was the actual PE ratio of those companies in 1995? You'll see on here, Alcoa trading at 10 times earnings, 3M trading at 22 times earnings, etc. Then he did another analysis. This was done in 2012, where he said, okay, if you wanted to match the market's return, how high of a PE ratio should you have been willing to pay for each of those businesses in 1995 in order to match the market's return? Look at the top one, 3M. 3M was trading for 22 times earnings, far more than Alcoa. Yet an investor should have been willing to pay 37 times earnings to earn a market matching return. So 3M was trading at 22 times earnings, and it was dramatically undervalued. Conversely, Alcoa was trading at 10 times earnings. Cheap, dirt cheap. Yet investors would have had to only pay 3 times earnings for the company in order to earn an 8% return. So Alcoa at 10 times earnings was incredibly expensive, incredibly overvalued. Bank of America traded at 7 times earnings. It should have traded at 3 times earnings. Caterpillar traded at 10 times earnings. It should have traded at 28 times earnings. So this to me just shows, just reinforces to me, when you solely focus on one metric like PE ratio, for example, that ignores so much else of what matters. You have to ask yourself, are these businesses growing? Do they have recurring revenue? What's the management team work like? Are they high quality businesses? If they are, you should be willing to pay a higher valuation for them today. And if they are a bad business, then you should be hyper focused on valuation. But I just really love this because it just trained in me. The best businesses deserve to trade at high multiples, and they should for a while. But when I think about valuation, I do look, and I have a methodology for tracking what valuation I look at when I'm buying a stock. Here are some very simple ones that I look at. I look at price to sales ratio. I look at price to earnings ratio. I look at price to gross profit, which is a highly underrated valuation metric in my opinion. But these are just very simple valuation metrics that just run off of the income statement. Here's another really important thing that I learned over time, and this wonderful graphic was compiled by our intern Brian Jack. If you think about the life stage of a company and how the PE ratio is developed, This really informs the way that I view PE ratio today. When a company is brand new and it catches an idea, it is often losing incredible amounts of money as it's growing and scaling the business. That's very common. If you look at a lot of companies that are growing fast today, they're losing money because it takes a certain amount of scale before they can get their operations to the point where they're profitable. That's the introduction phase. In this phase, the PE ratio is negative. So the PE ratio is utterly useless because there's no earnings. In stage 2, they're really starting to pick up their hypergrowth and they cross into profitability. At this point, their earnings turn positive. However, they're nowhere near optimized for profits. So if you suddenly go from not making profits to making profits, your profits are going to be minuscule. Because of that, the price to earnings ratio is going to look insane. It's going to be like, I can't buy this stock. It's trading at 2,000 times earnings. But you're missing the point that the company isn't yet optimized for profits. Therefore, the PE ratio is going to be insanely high, and it's going to be a useless number. In stage 3, that's finally when the PE ratio starts to make sense. This is when a company is big, mature, and it's fully optimized for profits. Then the price to earnings, aka price to profit ratio, is normalized, and you can actually look at it to start making decisions. And importantly, companies can be in any of these stages for long periods of time, right? Companies can be losing money for 20 years. They can be in the introduction stage for 20 years. They can also be in the maturity stage for 50, 100 years, right? We've seen some companies that are that old. Finally, when you get into the declining part of your business, this is a dangerous time to invest in a company because the company itself is being disrupted. Its core market is going away. And because of that, Wall Street typically bids down the valuation because it sees that disruption coming. And a lot of companies you'll find in this stage are trading at 5 times earnings. Maybe they have a dividend yield that's like 7%, 8%, 10%. And it can be very enticing to be like, wow, this company is cheap. It's dirt cheap. The story can't be this bad. However, if that company is ultimately heading towards stage 5, where it's going to start bleeding capital, that PE ratio, that low PE ratio, is a mirage. It can be totally dupe you into thinking that it's a great buy, but if its earnings are heading towards 0 permanently, the PE ratio won't save you. So this is just a mental model that I always keep in mind when I'm looking at a company. So here's another way to think about it, another way to look at that. When you're looking at the valuation of a company, depending on what stage it's at, in the beginning, before a company has a product, and there are companies out there that are on the market today that don't have any revenue, there's nothing you can look at that says this is a great buy. It's the price to hope ratio, right? Once they launch the product, the price to sales ratio becomes typically the metric that I pay the most attention to because, again, there's no earnings. Once they become profitable, once they cross over into the hypergrowth stage, that's when I start paying attention to the price to gross profit ratio. I basically work my way down the income statement as each line item is optimized for. Finally, when they're in the maturity stage, that's when I focus on the price to earnings ratio. So today, in 2021, that would be companies like Microsoft, Intel, Apple, Coca-Cola, Procter & Gamble, big, huge, mature companies that have been producing stable profits for years. For them, I would look at the price to earnings ratio. And then finally, when they're in that declining stage, there's nothing that you can look at. Here's the other important point that I want to hammer home, or that my mentor, Tom Engel, really taught me. When you find a great company that's growing, you want to add to that company over and over again at better and better valuations. What that means is if you buy a company, if you like a company and it's trading at 10 times sales, you buy it and then you wait and watch. And your goal is for your next buy to be at a lower valuation than your first buy. So maybe you want to pay 9 times sales. How could you do that? Well, there's 2 ways. Well, there's 3 ways. One is the stock price fell. 2 is the stock price didn't move, but earnings or sales went up. So the valuation got better. 3, the stock price went up, but sales grew even faster than the stock price. So if sales doubled, but the stock price is only up 50%, while you're paying a higher price, the valuation is better. So I have a tweet storm on this if you're interested in this methodology. But the big thing that I've learned is that these factors matter to me far more than valuation does. And this is why I take companies through my checklist, because I want to screen for these qualities in a business and not overly focus on valuation. A few final points here. If you look back at the long-term returns of some of the greatest stocks, Microsoft, Home Depot, and Apple over the last 25 plus years, and then you chart their earnings growth, aka their net income growth, look at that. They're pretty closely aligned with each other. Microsoft is up 254,000% since its IPO, and its earnings, aka its net income, are up 210,000%. That's not an accident. Stock prices in the long term follow earnings. In the short term, they don't. In the long term, they do. So what mattered with Microsoft? What mattered with Home Depot? What mattered with Apple? It mattered that you bought them. It didn't matter what valuation you paid. The only thing that mattered is, did you add these companies and other mega winners to your portfolio? Not so much, did you pay the perfect price? There's another slide shamelessly stolen from Morgan Housel, but it just so hammers home this point to me. In the short term, valuation matters a tremendous deal, right? Little changes in what investors are willing to pay, aka the valuation, has a huge effect on the share price. But over time, as you move along, earnings become the bigger and bigger driver of what moves the share price. You and I are long-term investors, Brian. We're focused on companies that we think can grow and grow and grow. So this is another reason why I don't overly focus on valuation, because I'm focused on what companies do I think can grow their earnings significantly. One final point here. If you bought Amazon at the absolute worst time in 1999, you paid some insane valuation, right? It was at the absolute peak of the dot-com bubble, and then the stock prompted to fall 90%. But if you held from the highest price you could have paid, you're currently up 4,300%. It's a 43 bagger and counting from the worst valuation you could have paid. What mattered is that you got Amazon into your portfolio, not that you paid the perfect price for it. And I just think about some of the biggest mistakes that I've ever made. It's passing on companies because I thought the valuation was too high, or the price was too high, or that the stock was already up too much. I passed on C Limited at 40 because I thought it was too high. It's over 200 just about a year and a half later. And this is a mistake that I've just made over and over again. And one of the biggest mistakes that I've ever made, and sadly, knowing myself, I know that I'm going to continue to make this mistake for the rest of my life. It was not buying great companies because I thought the valuation was too high. I've made that mistake so many times. I didn't buy Salesforce.com in 2006 because I didn't like the PE ratio. It's multi-bagged so many times over since then. And that's because I didn't understand the relationship between the business and the stock in the long term, and I was just overly focused on this company. So we hope that gives you a little sense about why we don't focus on valuation when we talk about stocks. Another thing that we wanted to point out is the point of this channel is to teach people how to invest better. Brian and I are really passionate about teaching people how to screen stocks, what principles to look for. And we want these videos to be timeless. We want you to watch a video we do about Coupang a year later and be able to learn from it. If we focus exclusively on the valuation, or we mention that, the odds are good that information would be useless. Any final thoughts on valuation, Brian?
Just because we do it this way doesn't mean that it has to work for you. But what I will say is that I think that in the media, financial media today, there aren't enough voices kind of saying it's okay to put valuation on the bottom of your list. And so us doing this video and also taking this approach isn't saying that you must invest like us. That's the last thing that we want. But it is us saying, hey, there's this other way. You might be interested in it. Try it out.
Yeah, exactly. I'm a big fan of getting multiple opinions on things and then forming my own. You don't look at valuation at all. I love that. I love that about you, right? I love that you're just like, forget it, because that's so opposite of what we're trained to do. Valuation is a part of my process and probably will be for a long period of time, but I've learned the hard way to de-emphasize it. So like you said, it's at the bottom of my list. It's not at the top of my list. And just as you just said, we're not saying this is the only way. There are so many other investors out there that will disagree with just about everything that we just said and said, these guys, they'll say, these guys are idiots. Valuation is the only thing that matters. Many of which we deeply respect as investors. So there's just no one right way to look at valuation. But either way, we hope that this explained to you why we don't talk about valuations when we're reviewing stocks, and probably why we won't for a long period of time. So if you have any comments, if you have any questions, please put them in the question section below. We love getting feedback. Brian, thanks so much for being here.
Thanks, Brian.